Looks like we are having another red day in the S&P 500, and today we want to cover Alibaba that has reported their earnings, and as we can see they have posted a profit beat. Great news, and that is on top of what is a fairly weak consumer environment, not just in China, but we are also seeing that across the US with big names reporting and talking about that as being one of the issues that they see. Now their bottom line's up 58% year on year, that is very positive to note, and their revenue, although it was up around 5% on the year on year comparison, we can see that is a marginal miss to what the analysts were expecting. So it does look to be fairly mixed. Earnings per share was a beat, but their revenue was a marginal miss. And we can now see the market has been open for a few hours. In fact, it is down around 3%. Not the greatest of news for current shareholders, and we want to understand, is this a company we should be considering in our portfolio, or is this one that actually doesn't look that undervalued? And what's also interesting to note, we have some of the latest 13F forms. These are where these super investors discuss what they have bought or sold in the more recent quarter. A lot of them are actually disclosing their buys in Alibaba. In fact, Michael Burry, no surprises, he has constantly talked about his love for this market. He's added another 45,000 shares to his overall portfolio, but we also have other super investors doing something similar. As we can see, Howard Marks adding around 102,000 shares to his portfolio. Now let's have a quick refresher of their performance. First thing to note, Seeking Alpha give this a buy, Wall Street give this a strong buy, and Quant, although we do see hold at 3.46, remember 3.5 does turn this into a buy, so they are, you could argue, on the fence. Right now it is trading at the mid to lower end of the 52-week range, a forward yield 2.21%, a forward P around 10.4, and over the last 12 months, not great at all, up 5%, massively underperforming the S&P, which is up more than 30% in the same time frame. And over the last 10 years, it has been down around 21%. So if you were an Alibaba investor 10 years ago, you would have less than what you initially invested. In fact, the all-time highs of this company was over $307 in October 2020, more than 4 years ago. Right now, trading significantly lower, around the $88 mark. When we take a look at their expected earnings, out of the next 4 quarters, they are expecting one to be a decrease, but overall 3 of the next 4 to be positive increases to the year-on-year earnings per share. However, we have to point out, over the last 4 quarters, they have missed on 2 of them, so their historical forecasting accuracy is about 50%. Good to report though, the more recent quarter was a nice substantial beat, and they are expecting an increase to the EPS over the next full annual accounts, March 2026, lowering ultimately the forward P to 9.31. Now we also want to see what are institutions doing, and in fact right now ownership sits around 13.5%, 3.1 billion worth of sales over the last year, and in the same time frame we can see a lot more buying, nearly twice as much, and we can also see in the more recent quarter, Q3, a lot more buying. So institutions like super investors, not just those 2 that we have briefly shown, but many others are starting to put a lot of money into the Chinese market. They believe right now it is the place to be. But as we always say, do your own due diligence, never copy what investors or institutions do, have your own investment thesis. Now we also want to run through some metrics. Now we don't get a dividend safety score just yet, but we can see the yield above 1%. In terms of dividend growth over the last full year, sitting around 5%, which is around the 4% we target just to keep up in line with inflation. And then we essentially get to some of their metrics. The first one, the free cash flow payout. As always, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Typically, we want below 60%. That reinforces and gives us faith that they can offer double-digit increases, not something we have seen in the more recent period, but we notice it is very low, 12% in 2024, expected to be the same over the next 12 months. Then we get to the free cash flow per share, where we want consistent increases over the long term. Now it's increased pretty much 4-fold from 2015 to 2024, and we do get inconsistency, and we should also let you know over the next 12 months it is expected to drop, although marginally, to $58.10. We then move on to sales growth. We're nearly double digit every single year, and very obvious, one of the issues we are seeing is a massive slowdown in sales. 2% in 2023, 8% in 2024, 6% on a trailing 12-month basis, so something you do need to consider when thinking about adding Alibaba to the portfolio. From a numerical basis though, when you do zoom out, it has increased rapidly, in fact more than tenfold from 2015 to 2024. And what we can see, they've done it all. They've done share buybacks, they've done share issuances. In fact, from 2015 all the way to 2021, they were diluting your position. Since then, they have implemented a share buyback program. But in fact, if you were an investor in 2015, you would pretty much see very minimal difference from that shares outstanding number to the trailing 12 month. Again, just something to consider as an investor. We then move on to ROIC, one of our favored metrics, 10% or more. Reason we always bang on about that gives us faith that management are able to effectively allocate their capital, pretty much straddling around 10% on a year-on-year basis, as well as in 2024 and on the trailing 12 month. And now we face a few issues that we saw on their top line sales. It was slowing down. We're seeing what we would call operating inefficiency. We want to see operating efficiency, where the margins increase over the longer term. We're seeing the opposite. Now look, the minimum we want to see here is about 16%, so you could argue and say it is around that in 2024, but just look at the trend, bear this in mind. Same thing to be said for the free cash flow margin as well. Looking very good in 2015, it's very good in 2024 as well, because we want a minimum of 5%, but just look at the trend. We don't want this to continue. We don't want the margins to get hit. It may not, but again, these are things that we would just say you should really have at the forefront of your overall investment thesis. Onto a lot more positive metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, correlates dividend safety, balance sheet strength, 0 right across the board, trailing 12 month over the next 12 months, tells us for Alibaba, it wouldn't even take them one day to pay off all of their debt, net of cash on hand, so a very, very strong balance sheet. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about severely undervalued stocks that deserve your attention, as well as what's gone on in the market over the last few days. So click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information, upside that Wall Street themselves see over the next year, and on top of that, a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, sign up, and you can read straight away. We then just want to show you their top line revenue growth as well as their bottom line. In fact, we already mentioned their top line revenue looking very strong, more than tenfold from 2015 to 2024, although we do notice the inconsistencies and the slowdown over the last few years. And in fact, on the trailing 12 month, it doesn't really give us that faith that it will be a strong increase into 2025. But ultimately, this part of the analysis, something we haven't touched upon yet, their bottom line net income, and unfortunately, very inconsistent on a year-on-year basis. Highest we've seen was 2021. Since then, over the subsequent 3 years, not only much lower, but pretty much flat. If you do zoom out though, 3.9 billion in 2015, 11.1 billion in the latest annual accounts. Then we want to show you the health of the company, total cash versus total debt, and we can see their cash over the longer term has in fact been increasing from this graphical format. 20 billion in 2015, 62 in the latest quarter, so actually tripled, but that is a good sign. But realistically, one number in isolation will never tell us anything, which is why we compare it to their total debt numerically and directionally. And as we can see, their debt, like their cash, has been increasing. In fact, over the longer term, it has gone from 8.5 billion to 33. Now, one thing we would say, net debt to EBITDA was 0, and we have already just seen their cash is far superior to their total debt. So, as we mentioned, wouldn't take them one day to pay off all of their debt, net of cash on hand. Then we move on to some gradings. Now, they get a C. When we actually take a look at the P on a non-GAAP basis, 10.4 is much lower than the 17.4 of the sector median, meaning if you're buying Alibaba right now, you are paying a 40%, or in fact getting a 40% discount to the overall sector. Is it worth it? Well, maybe you could argue that poor companies deserve to be trading at a discount, or question is this an overreaction by the market? Again, something we'll cover when we come to our own valuation. Depending on what valuation metric you use, some show actually a premium, some in fact do show a discount. The one we're focusing on today though is that PE where we get that 40% discount to the sector median. We then move on to the growth where we get an overall D-, yet on a year-on-year basis, 6% is higher than the sector median at 1.64. Forward looking, also higher, 7.15 versus 3.13. And when we come to the earnings per share over essentially the next 3 to 5 years, it is anticipated to grow 11.5%, a little bit better than essentially the sector of 10.3. So I do think this D grade or D- is in fact harsh, but you can see the metrics here. We then move on to the profitability where they get an A+. Gross profit margin, 38%, pretty much in line with the sector median, around the same figure. Bottom line, a little bit better, 7.4 versus 4.5. And we can see their cash from operations over the last 12 months, 24 billion, significantly higher than the sector median at 275 million. So a quick recap for this part of the analysis: a buy from Seeking Alpha, a strong buy from Wall Street. As we said, quant on the fence between a hold and a buy. C on valuation, which we disagree with. D- on growth, again we disagree with, and an A+ on profitability. Now, two more things before we jump into the valuation. First one, how does their performance compare against others in the broadline retail industry? Is there an issue with Alibaba, or is it in fact relating to the overall market? And we can see over the last 12 months, total return, so including reinvesting dividends, Baba one of the worst performing, up only 8%. And then we zoom out over the last 5 years and we actually see it down 51%, one of the worst performing over in fact the last 5. And then when we get to the last 10 years, we can see again another negative performance, negative 18. Now, this is absolutely terrible over the last 10 years, but remember, it could perform much better over the next 10. In fact, it could perform much worse, as the past performance doesn't define the future. But again, lots of considerations to make. And the final thing, although we already know what the answer is comparing it against the S&P's performance. Over the last 12 months, S&P massively outperformed. Over the last 5 years, another massive outperformance. And we can see again that same trend over the last 10. So always have that consideration for perhaps a low-cost ETF as opposed to individual stocks. If you don't have faith, they will outperform over the longer term. Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $125, we got it as the average of these three models. So the intrinsic value of $125, we got it as the average of these three models. And as we get into the first model, we can see Graham's valuation, the EPS, the long-term growth rate, the AAA corporate bond yield, giving us our first undervaluation signal. In fact, massively undervalued. But as always, remember, we're not looking at any one of these models in pure isolation. We then have the multiples valuation, companies in a similar sector and size that we just analysed, their average P multiplied by the EPS of Alibaba to actually give us our first overvaluation signal. So it's 1 for 1. Now, typically we would use the dividend discount model. However, in this case, they have just started to pay a dividend, so we may use it in a future episode. We then get to the discounted cash flow model, free cash flow year on year, average growth at 20% over the last 10. We've gone extremely conservative at 0%. With the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, 149, giving us our second undervaluation signal. 2 undervaluation, 1 overvaluation, the average $125 in today's episode. Now remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alibaba or any others that you do desire. And jumping into the calculation, we always like to use a margin of safety on this channel. We execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, buy up to $113 in today's episode. Then we keep going till it's near the current trading price. And what we can in fact see in today's episode for Alibaba, you are getting a 30% MOS around the $88 mark. Now we have covered this in other episodes where we do take a look at some of the bullish as well as some of the bearish catalysts. So do bear in mind there is a lot more to this company than what we have just covered today. But as always, we are interested in hearing your thoughts. 30% margin of safety. Wall Street, as we saw, a very strong buy rating, $125. Lots of super investors are buying. Now 41% upside, 30% MOS. Do you consider this to be a buy, hold, or sell? As always, give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified when these videos drop. Don't forget to sign up to the free weekly newsletter below. We're dropping a new one to your inbox on Monday morning. And also come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.